CMQ investors, welcome to the show. It's great to have you here. Today is March 10th, 2022. And based on the feedback from our recent news episode, I'm going to do this again because you guys said you liked it and I want to keep trying it. So here's what's going on in the world right now. I will have to warn you, it's not good. It's actually very bad, but this will not be a depressing podcast. Hopefully it'll be one that helps you stay calm and just like we all need to do, just stay the course, not panic sell, and keep the long term in mind. I'm going to start here with the headlines. First and foremost, I think the big thing outside of the war going on right now, which we've discussed before, is inflation. There's a headline on all of the major publications that I read, including Barron's, the Wall Street Journal, the Financial Times, Bloomberg, about inflation reaching a 4-decade high of 7.9%. So, all those gains that we saw in the market in the last couple of years with the stimulus and everything else, this is the second order effect from that. So, according to the Wall Street Journal, and this is written by Gabriel T. Rubin, rising energy, food, and services prices push already elevated U.S. inflation to a 7.9% annual rate last month, another 4-decade high, with oil and commodity market disruptions from the Ukraine crisis expected to add more cost pressures. The Consumer Price Index, which measures the cost of goods and services across the economy, hasn't been this high since it was 8.4% in January 1982, when the nation was in a recession and trying to tame what had already been double-digit inflation. And let me just say something about that really quickly, because this is the first time I'm reading this article, as is the case with all these articles that I'll read from. But that's a reminder that this has happened before. People have lived through this before. This is not the first time. So it doesn't make it any easier. It doesn't make us, any less comfortable looking at, these numbers. But these things happen. This is part of, as Charlie and Warren would say, the normal vicissitudes of life. So if we are long-term shareholders, this is part of the game. If we are going to realize the long-term advantages of long-term compounding, this is what we have to deal with. This is the cost in a way. This is us paying dues, call them emotional or psychological dues, in order to realize that long-term outcome. So I need to hear that just as much as I need to say that, because I'll tell you, I don't even want to look at my portfolio again today because it makes me a very sad young man. So I continue here. Higher energy prices, including gasoline price increases, help push up the inflation reading, along with cost gains for groceries, restaurant food, transportation services, and apparel. Strong demand for goods from consumers and supply chain constraints related to the COVID-19 pandemic have elevated inflation over the past year, with persistent shipping bottlenecks and shortages of supplies like semiconductors rippling across the economy. A historically tight labor market also has pushed wages higher and led to more open jobs than there are workers looking for work, leaving businesses struggling to keep up with demand. Economists expect additional price increases related to the Ukraine crisis after crude oil prices in March hit their highest levels since 2008, and U.S. gasoline prices reach record highs. And if you want to read the entire article here, it is titled, Inflation Reached 7.9% in February. Consumer prices are at the highest in 40 years, and it's in the Wall Street Journal. Now, to the stock market we go. Please strap on your seatbelt. U.S. stocks accelerated their losses and oil prices rose in afternoon tradings as talks between Russia and Ukraine yielded little progress and inflation readings reached a 40-year high. Dun, dun, dun. Wah, wah, wah. That's actually me making that sound if anyone's wondering. They're like, where do I get that sound effect? The NASDAQ Composite Index fell about 2%, while the S&P 500 declined about 1.3% on Thursday. The Dow Jones Industrial Average was about 1% or 335 points lower. All three indexes were poised to finish down for the third time this week after breaking a 4-session losing streak Wednesday. And I have to say, yesterday I was almost going to record a podcast being like, see guys, you you never can time the market, never know, everything's going to be okay. And it's just like, nope, that was a false flag. Investors are worried about the global economic outlook, sapping their appetites for riskier assets in recent days. The S&P 500 and Dow Industrials remain in correction territory, while the NASDAQ is in a bear market. Wow. Okay, quick reminder, and I don't have the data in front of me, but this is from memory, so we can come back and fact check it. But there is on average, since I believe 1928, a correction on average, I said, every 19 months. So this is something that does happen. Don't let the word corrections, make you too scared or anything like that. I'm not saying it makes it any easier to cope with looking at your portfolio and seeing all those, all those great gains I'm sure you have just basically evaporating. But remember, this is, as I said, it's kind of like paying dues to be a long-term shareholder and to benefit from compounding over the long term. All right, let's move on here to the Financial Times. There's an article about the rising cost of China's friendship with Russia, which we might have to come back to. But I want to talk about something else first, and I'll use Bloomberg as a reference point here. A lot of our fellow CMQ investors have asked about this, and that's about Amazon's plan to split their stock. So the headline reads, Amazon jumps on plan to split stock buyback up to $10 billion. This split would be Amazon's first in more than 2 decades. The changes are aimed at more employee flexibility, Amazon says. This article was written by Jaron Wittenstein, Spencer Soper, and Matt Day. It reads like this. Amazon is planning to split its stock for the first time. I have to not read the headlines. Amazon is planning to split its stock for the first time in more than 2 decades, in a move that will end an era of 4-digit stock prices for the biggest U.S. technology companies. Amazon intends to boost its outstanding shares by a 20-to-1 ratio under a plan disclosed late Wednesday, joining other technology giants like Alphabet Incorporated and Apple Incorporated, who have turned to splits to make their stock more attractive to retail investors. That news, combined with the $10 billion share buyback authorization, sent Amazon shares up much as 11% in New York post-market trading. As Amazon's stock price has ballooned over the years, a potential split has been a frequent subject of speculation, which was only heightened by Alphabet's proposed 20-for-1 split disclosed last month. Amazon conducted 3 splits in the 2.5 years following its initial public offering in 1997 and then halted the practice. The topic occasionally came up at Amazon shareholder meetings, but the company hadn't taken action until now. The e-commerce giant, in an emailed statement, said the split is aimed at giving employees more flexibility in how they manage their equity, as well as making the stock more accessible for average investors. Amazon's split, like Alphabet's, requires shareholder approval and would take effect in June if cleared. As an Amazon shareholder, I'm not sure if I'm going to approve on that, guys, and I don't know. All right. Amazon is learning from Apple how a slower growing technology company can still be a popular investment, said Tom Forte, an analyst with D.A. Davidson & Co. Forte continues and says that the stock split is kind of an old school strategy to lower your share price to stimulate interest among retail investors. The stock buyback tells investors that they have plenty of money sitting around and aren't planning a big investment on building new warehouses. Alphabet and Amazon are the last 2 of the 5 biggest U.S. technology companies by revenue that have 4-digit stock prices. Amazon shares closed at $2,785.58 on Wednesday, up more than, wait for it, 4,000% since its last stock split in September of 1999. Remember, long-term, guys. Share splits had almost disappeared from U.S. stock markets recently, with only 2 in 2019, compared with 47 splits in the S&P 500 in 2006 and 2007, according to Bloomberg compiled data. But Apple and Tesla have helped revive the practice after splitting their stocks in 2020. A lower stock price makes it easier for mom-and-pop traders to buy shares rather than purchase fractional stocks through their brokerage firms. It may also pave the way for inclusion in indexes, such as the Dow Jones Industrial Average, which is weighted by a company's stock price and not by its market capitalization. Amazon shares have fallen 16% this year amid a broad sell-off in technology stocks as the Federal Reserve prepares to raise interest rates. Michael Pachter, an analyst at Wedbush Securities, said the stock split is also most likely part of a broader compensation changes underway at Amazon, since workers feel less slighted if they receive an entire share of stock rather than a fraction of share. Psychological. Stocks that trade for $100 or less have a bigger base of retail investors, but I don't think that's why Amazon is doing this, Pachter said. It means absolutely nothing except that Grandpa can buy little Johnny a share of Amazon stock. Who's got this? What grandpa is doing that? Makes me a little angry at my grandparents. No, just kidding. Rest in peace to my grandparents, by the way. My grandparents are not with us, but that's just find that funny. It means absolutely nothing except that Grandpa can buy little Johnny a share of Amazon stock. Well, how does he know that little Johnny even likes that stock? Okay. Jokes aside, let's keep it moving. Peloton. There's an article, a feature article. I'm not going to read this, but I want to mention it to you guys since I'm reading from Bloomberg. And we've talked about Peloton in the past. It's a feature article about Peloton getting trapped in its trillion-dollar fantasy. It reads that fueled by manic demand during the early days of COVID, the company spent the next 2 years chasing a dream of fitness dominance. I'm excited to read that. There's also an article here that I'm going to read from, that's going back to the news here. It's about a company that many of you who are my age, maybe even older or younger, will remember, a company called LimeWire. It says that LimeWire is making a comeback, but not as you know it. A pair of serial entrepreneurs in Austria has bought rights to the defunct music platform LimeWire with plans to revamp its image for the internet's next generation by selling non-fungible tokens attached to music, content, and artworks. LimeWire, one of the earliest iterations of web-based music consumption, with a reputation as a haven for illegal downloads, ended in controversy in 2010 after a judge shut down the business over inducing copyright infringement, which was then followed by a $105 million out-of-court settlement between major record companies and LimeWire's then CEO, Mark Gorton. Now, brothers Paul and Julian Zettemeyer are hoping to use LimeWire's early 2000s fame to attract users to their Cryptosphere platform, with the two spending most of last year steadily acquiring the various parts of LimeWire's branding. Launching in May with no affiliation to LimeWire's original team, the new company, LimeWire GmbH, will offer musicians the chance to gain more revenue from their music than they might on other sites such as Spotify or Apple Music. It's a very iconic name. Even if you look on Twitter today, there's hundreds of people still being nostalgic about the name, said Julian in an interview, who will act as co-CEO alongside Paul. Everybody connects it with music, and we're launching initially a very music-focused marketplace, so the brand was really the perfect fit for that with its legacy. LimeWire will debut with support for buying and trading music-related non-fungible tokens such as exclusive songs, merchandise, graphical artworks, and experiences like backstage content. The startup will also launch its own utility token via a private sale within the next 3 weeks, which Paul said would be used like a loyalty program. Unlike other NFT marketplaces that transact predominantly in cryptocurrencies, all assets on LimeWire will be denominated in US dollars so as to expand its marketability to mass audiences, with payment accepted in crypto or fiat currency. The platform will also offer Bitcoin and Ether wallets and custodial services for the tokens themselves, facilitated through a partnership with blockchain payments firm Wire Inc. Julian said around 10 quote-unquote really big mainstream artists have signed on to be part of LimeWire's offering so far. Additionally, members of the management teams behind award-winning artists HER and the Wu-Tang Clan will be joining the startup board as advisors, along with Wire CEO Giannis Giannaros, an NFT consultancy Six Agency, which facilitated the purchase of a rare Wu-Tang Clan album from the U.S. government for Pleaser DAO last year. The acquisition of LimeWire's assets and all current business activities are currently being financed out of the pair's own pockets, having exited two of their own startups in recent years. Though Paul said this has provided LimeWire with a solid runway for the foreseeable future, Julian added that the company may seek outside funding later this year. Okay, that article, again, you can read the full article on Bloomberg.com. Interesting, though, and I don't know, I wish them all the best. I feel like I've seen this movie before. I think it was Justin Timberlake was part of a group that bought back MySpace and was trying to leverage, the brand to do basically like, a revamping and hoping that would, be enough. I think this is a very challenging thing they're doing. It certainly has all the makings that would get, venture capitalists excited, and there's like a huge upside here if it worked. But, one of the challenges is getting all the customers or the users to use the platform. And, that's something where they've got a long way to go to catch up with the Spotifys and the Apple Musics, et cetera. So, like I said, wish them all the best, but I feel like I've seen this movie before, just not with the NFT crypto component. So, interesting, though. Very interesting. All right. What else we have here, guys? Another article. Again, I'm on fortune.com right now, and there's also the headlines are all about inflation. You can check that out. I think it's all pretty self-explanatory. Explanatory? I can't even think right now. I'm just thinking about my money evaporating from inflation. Let's check out Barron's.com. That's the last place I want to go, and then I want to leave us with some thoughts so that we all can hopefully stay sane as one bad headline comes after another. Okay, Barron's, here's what Barron's is talking about. And Barron's is much more of like a actionable, do this right now kind of a platform. It's different than the Wall Street Journal and some of the other sources we often read from. And that's why I like to include it. I enjoy Barron's a lot. Inflation hits another 40-year high. Jobless claims rise. They mentioned the Amazon stock split being cheered on by Wall Street. Curious, too, if they have a different perspective as to why Amazon's doing that. The VIX, which measures, it's like the volatility index. It says wild ride, ? The VIX, measuring expectations for how wildly markets will move, remains far below the level early in the pandemic. There's an article here about Peloton's new CEO has plans to fix the company. that's kind of the gist. I know people are looking out for Rivian's earnings today. I actually saw a Rivian truck in the wild here in Manhattan a few days back. I posted a picture to the Charlie Motor Quotes account, to the stories of that account. So I was nerding out. I was like, oh my God, it's a Rivian. It's like I was seeing some endangered species. Let's talk about, what did Joe Biden say about this cryptocurrency executive order? I know that was something I wanted to talk about, and I feel like the news cycle has moved so fast, I haven't had a chance to really share about it. Let's see what we know about this, and then we will wrap things up. So just typing this in now in real time. All right. This is from CNBC.com. It says Biden just put out an executive order on cryptocurrencies. Here's everything that's in it. And this is written by Ryan Brown. Okay, U.S. President Joe Biden signed an executive order on Wednesday calling on the government to examine the risks and benefits of cryptocurrencies. Okay, so okay, that's pretty much it. Okay, it's a long-awaited directive that has had the crypto industry on edge, not least due to growing regulatory concern around the world surrounding the nascent digital asset market. There had been reports of a divide between White House officials and Treasury Secretary Janet Yellen, leading to delays in the policy rollout. The crypto market got wind of the executive order overnight after the Treasury accidentally put out a since-deleted statement calling it historic and releasing some of the details ahead of time. Weird emphasis. The order was finally signed Wednesday, and it calls on federal agencies to take a unified approach to regulation and oversight of digital assets, according to the White House fact sheet, which I'm going to load up as well. Let's see what that says. Let's go right to the source. And this is titled, and this is on whitehouse.gov, fact sheet. President Biden to sign executive order on ensuring responsible development of digital assets. Digital assets, including cryptocurrencies, have seen explosive growth in recent years, surpassing a $3 trillion market cap last November and up from $14 billion just 5 years prior. Surveys suggest that around 16% of adult Americans, approximately 40 million people, have invested in, traded, or used cryptocurrencies. I've been one of those people since, I think, 2016 or 2017. Over 100 countries are exploring or piloting central bank digital currencies. They use an acronym here that we should probably get familiar with, CBDCs, like CBDCs. CBDCs, a digital form of a country's sovereign currency. The rise in digital assets creates an opportunity to reinforce American leadership in the global financial system and at the technological frontier, but also has substantial implications for consumer protection, financial stability, national security, and climate risk. The United States must maintain technological leadership in this rapidly growing space, supporting innovation while mitigating the risks for consumers, businesses, the broader financial system, and the climate. And it must play a leading role in international engagement and global governance of digital assets, consistent with democratic values and U.S. global competitiveness. That is why today, President Biden will sign an executive order outlining the first ever whole-of-government approach to addressing the risks and harnessing the potential benefits of digital assets and their underlying technology. The order lays out a national policy for digital assets across 6 key priorities: consumer and investor protection, financial stability, illicit finance, U.S. leadership in the global financial system, and economic competitiveness, financial inclusion, and responsible innovation. Specifically, the executive order calls for measures to, and let's get into it, protect U.S. consumers, investors, and businesses by directing the Department of Treasury and other agency partners to assess and develop policy recommendations to address the implications of the growing digital asset sector and changes in financial markets for consumers, investors, businesses, equitable economic growth. The order also encourages regulators to ensure sufficient oversight and safeguard against any systemic financial risks posed by digital assets. Next, protect U.S. and global financial stability and mitigate systemic risk by encouraging the Financial Stability Oversight Council to identify and mitigate economy-wide financial risks posed by digital assets and to develop appropriate policy recommendations to address any regulatory gaps. And then next, mitigate the illicit finance and national security risks posed by the illicit use of digital assets by directing an unprecedented focus of coordinated action across all relevant U.S. government agencies to mitigate these risks. It also directs agencies to work with our allies and partners to ensure international frameworks, capabilities, and partnerships, and making sure they're aligned and responsive to risks. Okay, there's a lot more here. Next up, we have promote U.S. leadership in technology and economic competitiveness to reinforce U.S. leadership in the global financial system by directing the Department of Commerce to work across the U.S. government in establishing a framework to drive U.S. competitiveness and leadership in and leveraging of digital asset technologies. This framework will serve as a foundation for agencies and integrate this as a priority into their policy, research and development, and operational approaches to digital assets. Next, promote equitable access to safe and affordable financial services by affirming the critical need for safe, affordable, and accessible financial services as a U.S. national interest that must inform our approach to digital asset innovation, including disparate impact risk. Such safe access is especially important for communities that have long had insufficient access to financial services. The Secretary of the Treasury, working with all relevant agencies, will produce a report on the future of money and payment systems to include implications for economic growth. That'd be interesting to read. I'm just going to skip ahead a little bit here because this is like something you can read on your own, and a lot of it's very vague and kind of, you get the idea. But that is an interesting point about just making sure it's equitable for all, because this is an example where, those who have more means, who are more, I don't know, I don't want to get too overthinking it, but there's just a group of people that are going to be able to capitalize on this. And it's important that, if this is going to be the future in some level, those who are at the, bottom end of the ladder, so to speak, are going to be left in the dust if there's not some sort of, directive to have inclusivity as to how this will affect everybody. I'm not sure what the implications are there, but it's, certainly you don't see a lot of people who are, look, people with money are able to take advantage of this stuff. And that's something that, that's the way the world is, but it's also important that there's a huge wealth disparity in this country that's only gotten worse. And I think, it's just something we got to be careful about, because that can lead to bad things, as history has shown us, when that gap gets too large. You can have the biggest house in the world, but if no one else can get food, well, they're coming in your house. They also mentioned here they're going to explore a U.S. central bank digital currency, the CBDC, by placing urgency on research and development of a potential United States CBDC. That's where, honestly, and I'm not predicting the future here. The space is so new, anything can happen, but I feel like that's where things are inevitably going to go. There will be a U.S. dollar version of a digital currency, and that will be kind of like the go-to. I feel like the Bitcoins of the world are almost more of the early stage pilots of, kind of figuring out, what will work and getting that market validation. It's almost like in the startup world, we talk about minimal viable products. But again, I'm not predicting the future. Obviously, I could be totally wrong, but just that's what I'm thinking right now. Anyway, so that's what's going on with the crypto. I think that's a good place to leave it. I want to go back to the stock market for a second here. Things are bad right now. These are crazy times. There's a lot going on in the world. There's a lot of uncertainty. We have inflation. There's wars. There's even the potential of, nuclear issues happening. There is all sorts of scary stuff that's happening in the world right now. And I think something that I'm trying to remind myself is this is normal to some extent. This happens and we're just going through it. And as I said at the beginning of the show, and I think it's something I'll probably emphasize again in future episodes, but to me, I'm trying to remind myself anyway, this is the part of paying our dues as long-term shareholders. I know both Warren and Charlie have talked about seeing their shares in Berkshire go down 50% ticker to ticker, and that just being part of the normal vicissitudes of life and what we have to deal with as long-term shareholders. But the real money to be made for the individual is in long-term holding. So obviously, this is not financial advice. I'm also saying this to remind myself of what I know is rational, but I hope everyone is staying calm and not doing anything too irrational. If I do anything with my portfolio that's irrational, I will be sure to share it here in future episodes, as I try to be as transparent as I can. I'm always working to be a better investor, and I think it's beneficial to rub my nose in my own mistakes and also to share, when I'm talking the talk and walking the walk and when I'm not able to walk the walk. So I appreciate everyone for listening. Please make sure you follow and subscribe on Apple Podcasts or Spotify. Follow us on YouTube. We have CMQ Investing on YouTube now. Of course, Charlie Munger Quotes on Instagram, Warren Buffett Videos on Instagram, just trying to help these great ideas spread so we can all be, more rational investors who think more clearly and are wiser about, how we're investing our savings for the long term. So wish you all the best, and we will talk soon. I appreciate you for listening. I know I say that a lot, but I really do. Thank you again. My name is Chris Franco. This has been the CMQ Investing Podcast. We'll talk soon.